Welcome to QAV America, Tony, the last QAV America of the year. This is episode 33. We're recording this on December 30th, 2025. It's hot where we are, cold where our listeners probably are. My boys were just in New York for Christmas with their mum. Got to see snow for the first time.
Oh, really?
I said to them, "What did you think?" They were like, "Yeah, it was fun for about an hour." And then we were like, "God, this is terrible. Imagine living in this." I said, "Yeah, imagine having to deal with that 3 months of the year. It's crazy."
Well,
But they're back in LA now.
to be fair, I've been to New York a number of times, and I never thought it handled snow well. You know, the colder cities where snow is a regular occurrence are set up for it, but New York's kind of, maybe it'll snow this year, maybe not. So we're not going to bother about infrastructure for it too much.
Well, it just had, I think, its biggest dump in 4 years the night before the boys left.
Yeah,
So
right.
they were stuck on the tarmac for 2.5
no.
hours waiting to get out and all that kind of stuff.
Yeah.
Well, I don't know. I've been to Utah in winter and it's built around snow that time of year. I'm sure they've got a handle on it, but it's still a nightmare having to shovel your driveway every day and defrost your car before you can go anywhere. Crazy.
Yeah.
I always said to people, there are places you can live where you don't have to do this for 3 months of every year. You can just move to a warmer climate.
Well, but then they say that where do I play ice hockey and go ice skating and do all my skiing?
Go visit. You go visit. You go,
Well, they go and visit the
visit a
warm
place for a
places.
week and then get out.
Yeah,
okay.
that's why Florida exists in the US and Mexico.
Yeah.
And what's
Well-
this one on the West Coast? Arizona.
Yes. I love Arizona. I want to get back to Arizona. It's very hot, but so pretty.
Mhm.
Such a pretty place. So many pretty places in there. All the saguaro cactuses and all the
Courses.
red. What?
Golf courses.
Oh, yeah. I don't care about golf courses. Cactuses, I like. Tony, don't have much news-wise to talk about in the US. Their market hasn't had a Santa rally this week. It's been pretty quiet. Things are still bubbling along over there, uncertainty about labour numbers, etc. But the economy, generally speaking, seems to be trundling along despite tariffs and all of the unknowns. But I did want to mention to you that in the last week, I finally launched our US Light portfolio. So for listeners in the US, what we've been doing in Australia for the last few years is we have our regular portfolio, a dummy portfolio that's our stable portfolio that we built over the last 6 years, but not a lot of trading happens in it. It's fairly well established. We don't tend to sell much. And that's good, but for people that just are discovering our show and are trying to figure out how to invest in the QAV style, it doesn't give them anything to play with. So I launched a thing a few years ago called QAV Light in Australia, where we have a much bigger portfolio of stocks that we trade in. And it means that I'm always sort of trading something every week, and new listeners, as they're learning the system, can trade along with us. We're buying and selling things on and off of our buy list, and people can sort of learn the system by following our trades in QAV Light, trading along with us if they want, or just watching our trades and getting a handle for how it works. And, then because everything is transparent, they can look back at it 6 months or 12 months or 2 years later and see what our performance was like. And we have full transparency of what we bought, when we bought it, what we paid for it, when we sold it, why we sold it, the whole deal. And it's a lot more fluid than our major portfolio is because it's stabilized. Same things happen with the US. I've been running the US portfolio for 2 years now. It's pretty stable. We haven't had to do a lot of trading. I have to sell something once every couple of months, but really it just sits there and ticks along. which is great. But again, for new American listeners, it doesn't give them anything really to play along with. So I've started the first QAV Light portfolio. It's something you get to see if you have a subscription. You have to have a QAV Light subscription in the US, and you get to see the weekly trade. So every week I will buy something off of our American buy list and add it to our Light portfolio, and then track that. And if any of the stocks that we hold in those portfolios trip up one of our selling triggers, I will replace it with something else on our buy list, and people in the US can follow along. Again, they can copy our trades if they want, or they can just watch our trades and, go back and have a look at it historically and see how the system works with real data and a real transaction transparency. So I launched that last week. I've added 2 stocks to it so far. The first one was Grey Media, GTN, I added last week, which has been on the top of the buy list for a long time. Interestingly, it's a television company that we've talked about. I did a deep dive on it a couple of months ago. And the one that I added today or yesterday is another TV business, and it's the company that I'm going to do my deep dive on today, which is AMC Networks, or AMCX. So that is interesting. And I added it because it was the top of the buy list this week. GTN was the top of the buy list last week. AMCX is the top of the buy list this week. And both TV businesses, which is interesting. And AMCX, as we'll see when I do the deep dive on it, it's not a healthy looking business, to be honest.
I agree. Yeah.
I've done some pulled porks over the last couple of months. I'm like, these businesses are making cash hand over fist and they're undervalued. This looks great. AMCX is not one of those. It's bleeding. But it was at the top of our buy list. So there's value in there somewhere. So we'll see as we drill down into it. But it's got a good story too. It's got a long story, not as long as some of the businesses, but it goes back decades and has some involvement with Hugh Hefner, which is always fun. So anyway, we'll get into that in a second. Before we do that, I thought I'd just do a quick overview, seeing as it's the end of the calendar year, which is the end of the financial year too in the US. Looking at our major portfolio over there, what we call the US dummy portfolio. Again, it's been running since, I think, September 2023. Since then, it is up 65.5%, a little over 2 years. So roughly, 30 odd percent a year on average. That doesn't include dividends. And the S&P 500, which we use as the benchmark, is up 55% over the same period of time, which is terrific performance. But as of today, we are doing quite a bit better than the benchmark over that period of time. Year to date, however, has not been great for us. Our portfolio is down 11.7% this calendar year versus the S&P up 17.4%. So has not been a good year for our portfolio, generally speaking. It had a lot of gains in its first year and then has given up some of those this year, but still overall doing very well. To give people an idea of the stocks that we hold in that portfolio and what kind of performance we've had over the 2 odd years we've been involved. We've been running it. The number one performer is Willis Lease Finance Company, WLFC, up 186%. The second one is Innova International, ENVA. It's up 173%. Euroseas, ESEA, is up 102%. And it goes down from there, but they're some of the big hitters in the portfolio over the last couple of years. None of the stocks that we hold, I should point out, are Mag 7 stocks. They're all QAV stocks, companies that in most cases have been around a long time, are generating a lot of cash, but available to be bought at a discount to what we think their valuation should be. We buy them, we hold them, and generally speaking, they tend to do relatively well.
Yeah, I think going back to the QAV Light service that you spoke about, one of the important things that QAV Light gives to listeners who follow it, and certainly it's been the feedback to me from our Australian QAV Light listeners, is that not only are we telling them every week what to buy, but we're telling them what to sell and when to sell it. And that's a fairly unusual thing for an investment service. And it's a thing which a lot of our listeners value the most, is that we'd like to be buy and hold forever investors, and sometimes we are, but that's a pretty rare thing. And if you look at the history of all indexes, Australia or the US or whatever, the stocks that are there now weren't the stocks that were there 20, 50, 100 years ago. So knowing when to sell is just as important as knowing when to buy, which is part of the QAV Light service and a part of managing the dummy portfolio.
Yeah, and, I think a lot of value investors in particular screw up their face when they hear that we don't buy and hold forever, because that is part of the mindset that you hear about in value investing. But my understanding of it, having been studying at your feet for the last 6 or 7 years, is that sometimes stocks go down and don't come back up for years, and they may come back, but your money could be working for you in the interim. So you would rather sell it on the way down, reinvest that capital into something that's going to go up and have your money working for you, rather than bloody-mindedly sticking to your original thesis and saying, screw the world, I'm right, you're wrong, I'm gonna prove it even if I don't get any returns on my portfolio for 10 years.
Well, I don't know where the buy and hold mantra came from, but it was certainly one that Warren Buffett espoused, so perhaps he was the reason for it. And he famously talks about the bus pass, which has 10 rides on it, and you stamp a ride each time you buy a stock, and therefore you should only buy 10 stocks, and that should do you for a lifetime. But of course, he sold plenty of stocks along the way and traded in and out of airlines in particular, and oil companies and all sorts of different things. And in fact, it was, I think it was the most recent episode of the Acquired podcast on Coca-Cola, where they said at some stage during their analysis that Warren bought it back when he did, and it was a great investment then, and he's held it ever since. But that investment is now doing worse than holding an index ETF for the S&P 500. So even the great Warren gets it wrong buying and holding. I know he would argue he hasn't had to pay capital gains taxes along the way and brokerage and stuff. My experience is that those things are definitely counteracted by putting your money to work as best it can at every stage of your investment career, and not just sitting and forgetting.
The way that I've passed it in my head over the years is buy and hold is actually a good mindset to have. Like, we're buying things with the intention. We're not day traders. We're not trying to trade in and out, and we are buying things thinking this is a good business, it's performing well, we can get it at a discount, and we are going to sit on it and hold it as long as we possibly can. And there are stocks in our portfolios that we've held for years, and they've continued to do really, really well. We just talked about some of them on the Australian show that we've held for, a year or two, and they've done 100, 200%. But there are reasons when we will sell a stock.
Oh, yeah.
We'll buy it with the intention of holding it as long as we possibly can. That's in our mindset. But if it shits the bed, we will sell it and put our money somewhere else, right? So
absolutely,
it's not binary. Yeah.
And I mean, even going back to Buffett,
the guideline, not a rule.
Correct. He studied at the feet of Benjamin Graham, and Benjamin Graham taught cigar butt investing. So he was looking for a cigar that was still had one puff left in it that he could pick up off the side of the street and take that one puff and then discard. So he wasn't really a buy and hold forever type investor either. He was trying to get one last gasp.
Initially.
Yeah.
Yeah. Now, on our Australian show, Tony, you spent quite a lot of time talking about an analysis that you've done recently. We've had a really good year in the Australian market. Our portfolios right across the board, particularly in the last 6 months in Australia, have done really, really well, up 30, 35%. And you were doing some analysis on some of the commonalities between the stocks that have done the best in the last year on the Australian market. And it led you to half an insight that you're continuing to explore regarding growth over PE. Do you want to just recap that maybe in a condensed form for our American audience?
Yeah, sure. So my portfolio has done well this year, and being year end, I've gone back to review it, looked at the stocks which have performed the best, and from what I could tell, looking at things backwards, so going back to the start of the year and looking at the buy list at the start of the year, and those stocks were on it, and then looking for commonalities, they all had a high growth over PE score. And that's the old Peter Lynch rule. He calls it the PEG ratio. I actually have turned it upside down for some reason. I can't recall why. But anyway, and we look for a stock which scores over 1.5 when you put its forecast earnings per share growth over its PE ratio. So it's growing faster than the PE ratio, and that should mean that you'll get your payback faster. And if you can buy it cheaper than the growth rate, then that's a good deal, is basically all it is. So we score it. That's certainly part of our checklist. And it was getting a score, gets a -1 if it's a negative forecast earnings per share, gets a +1 if it beats the hurdle. But the stocks which did really well for me, which are all triple-digit returns, have high growth over PE scores of like 8 or 9 times forecast growth over PE.
They did have at the beginning of the year.
Yeah, that's a good point.
Yeah.
So those stocks now have much lower growth over PE scores because they've grown a lot during the year, all things being equal. And perhaps their outlooks aren't as good now as they were at the start of the year. So I did some analysis on that and looked at the stocks on the buy list. I think from memory, the numbers were something like if you bought all the stocks on the buy list on an equal weighting, you got 18% return, buy and hold for the year. And that doesn't apply all our sell methodology along the way. It was, I just wanted a quick and dirty look at performance. But if you ranked them by growth over PE, then you got more like 45%. And if you took the highest ones, only you were getting over 50 or 60%. So I think there's something in growth over PE, and I'll do some more research on that and see if we can adjust our score to give it more weighting in our methodology. I'm a little bit mindful of the fact that this could have just been a year where that particular metric did well, because in Australia we've had a couple of interest rate cuts, and sometimes growth stocks do better when interest rates are coming down. Because people see that companies pay less for their debt, or they have more spare cash to invest, so they invest them in more speculative type stocks. I also compared a full list of stocks that have positive operating cash flow, which is our first filter, but there's a couple of hundred stocks there, and their growth over PE rankings compared to the results I was getting, and they were very good. They were even better. But in the top 20 stocks ranked by growth over PE for all stocks, there were still, I think, 4 QAV stocks on the top 20 list, and they performed even better still. So I think the fact that we are value investors and we're looking to not overpay for growth, has an impact on our returns. I'm going to do some more analysis on other years where there's been interest rate rises and any other thing that's going on. Like at the moment, some of the stocks are mining stocks, and we know that gold's having a terrific run, which affects Australian stocks or gold mining stocks. So there's a few things to unpack there, but at the moment I'm thinking about using the score from the growth over PE as a raw score input into the QAV score for a company. So factoring the growth side of things as well as the value side of things.
We can also take the US buy lists over the last couple of years and run it over that as well, the analysis, and see how that plays out.
Yeah, that'd be useful.
Very interesting.
Because I did look at the AMCX buy list, and it's got a negative forecast growth. So that may well count against it if we change the methodology. Yeah.
Yeah. Well, Let me see, what else have I got on my notes? Nothing. Well, we did also talk in the last show, Australian show, about global equity markets this year, how they've done well. Europe's stock 600 is up 16.6. The S&P 500 is up 17.3. The UK FTSE 100 is up 21.5, but Hong Kong is up nearly 29% and Japan is up nearly 35% this year. We talked a little bit about some of the reasons why Hong Kong and Japan might have been doing well, but its bottom line is it's been a bonkers year for equity markets around the world. It's one of those years where, honestly, it's a little bit hard to get it wrong as an investor if you have a system and you know what you're doing. I do see some people on some of the investing subreddits and forums talking about how they've had terrible years. And our portfolio in the US, as I said before, has actually gone down this year. It hasn't had a great year, all told, but we haven't done a lot of trading in that portfolio this year either. It's just been coming off highs from last year. I think a lot of them just had, like WLFC went up 300% last year, and then it's given up some of those returns, which makes it artificially look like a bad year, but it's not really.
We had the same
It's
thing
weird.
when the Australian dummy portfolio started 6 years ago. I think it did like 400% in the first year. And then it sold
Yes.
off in the second and stabilised at double market going forward after that.
Yeah. It was during COVID. It just exploded during COVID, and then it sort of gave up some returns.
And we had the reverse thing
And-
happen
and
with some
I've
of the
learned-
light portfolios too, where they underperformed at the start and now they're outperforming. So it just
Because
reinforces
we started them.
Yeah. It just reinforces in my
bad
mind
times.
that when you start's an important indicator of how you perform, but over the long term, it doesn't really matter. But you've got to stick it out for the long term.
Yes.
You can't say, I started a portfolio and it hasn't done well, I'm going to quit it. Or I did well last year and not good
Yes.
this year, I'm going to quit.
Well, you can.
You can, but that's wrong.
A lot of people do.
That's right. That's human
Yeah,
psychology.
one of the things that I've become convinced of in the 6 or 7 years we've been doing this is just realizing that there are cycles in the market, and that the QAV system performs really, really well during some phases of the cycle, and then performs poorly in other phases of the cycle for a whole bunch of reasons, and then performs okay in the other phases of the cycle. But over like a 5 to 10 year period, you get enough periods where it really outperforms. Like, you know, in Australia, we've done, in the last 6 months, our portfolio has done, you know, I think the light portfolio has done 35% versus 4% for the index in the last 6 months. So it's massively outperformed for 6 months, and that might continue. It might not. We don't know, but we get so much wind in the sails of the portfolio in that period, then we can afford a few years of average performance. It'll come back down to double market. Then we'll get another 6 months, year of massive outperformance. And, you know, it just goes in cycles, right?
And unfortunately, I can't spot what causes the down years. And I can't spot what's caused the good year for the last 6 months for us either. So it's really hard to know. It's like sitting at a blackjack table and trying to guess what the next hand is. You just don't know. But you look back over a run of half a dozen hands and you go, gee, that was a good run. And you just don't know why.
But you know, double market is, long-term double market is great performance. And we know that the system has done that for you for over 30 years. And I've seen it do it in the last 6 or 7 years in Australia. And so it's just, I don't think too much about it. I just know that if I just follow the rules, follow the system, over the long term, it all works out. And as I always explain to people, I did it with Scott on our show last week, is at the end of the day, the basic thesis of QAV is we're looking for companies that are performing well, and then we buy their shares when we can get them at a discount to their valuation, and we assume that they'll probably re-rate, the market will re-rate them at some point through either, you know, somebody getting on board or an acquisition, or people waking up that, oh, this company's actually cheap, we should buy it. Something will happen and it'll, what do you call it?
Regress to
the mean.
Yep.
Yeah.
Yeah.
And
that's certainly the case.
It won't happen every time, but it happens more often than not.
Correct. Yeah. That's a good summary. I'd just like to add that it's also the system's kind of been put together by inverting what doesn't work. So we focus on quality metrics, so we try and get rid of the bad apples. We focus on cash flow, so we try and get rid of the duds. We focus on, valuation, so we don't overpay. All those kinds of things that can trip you up. It's like being a supermarket operator selling fresh fruit. You have very stringent controls on the fruit and veg you offer it to the public, and that means you've always got a good offering. That's how I look at it. We're a filtering of. It's like if the index is all the apple and you take out the bad apples, then you should be getting twice the index.
Yeah, it's just a simple premise that's hard to argue with. Right? So it just works. It's not mystical. It's not magical. It's just, it looks like it at the beginning, but it's really just common sense in a spreadsheet.
As you say, if
it's not that common.
Spreadsheets aren't your thing and you don't have the time to do your own downloads and analysis and things, then QAV Light might be for you as well, where you can just trade along.
That was one of the reasons. Yeah, we created it because some people said, I don't have time to do it. Too hard. Just tell me what to do. Well, speaking of that, I'm going to talk about this company that does not look good, but is at the top of my buy list this week.
A cigar butt.
Yeah, well, it could be,
yep.
Or maybe it's not. Maybe there's hidden things going on in there that
maybe
is not obvious. But look, so it's, as I said earlier on, it's AMC Networks, AMCX, not to be confused with AMC Entertainment, the cinema chain and meme stock circus over the last few years, to the moon, etc., and Wall Street bets. This is a different company. This is the company that you probably associate with Breaking Bad, Mad Men, Better Call Saul, or The Walking Dead. 3 really great shows and a terrible show, as far as I'm concerned.
Well, I'd score it a little bit more harshly than that. But anyway.
More harshly? What, Walking Dead?
No.
Or those other shows? You didn't like those other shows?
No, not really. Mad Men, okay, but I just can't get past the first few shows.
Oh,
Better Call Saul was okay.
Loved Mad Men. I loved Breaking Bad. Loved Better Call Saul. Walking Dead, I watched the first season and it was like, it's going nowhere.
Yeah.
Love the comic book of Walking Dead, but not the thing. Hey, my camera's going blurry. But my boys love The Walking Dead. Well, they've been loyal to it for nearly their entire lives. I think they started watching The Walking Dead when they're 11. They're now 25. They still cling to it. It's a bit like their X-Files.
Yeah, right.
I watched the X-Files go downhill over years, but kept watching just through bloody mindedness. Anyway, so the interesting thing about AMCX is they had all of, whether you like those shows or not, these were huge shows in popular culture, but they're not producing them anymore. And as I said to you off air before, like one of the interesting things is that Vince Gilligan, who made Breaking Bad and Better Call Saul, his latest show, Pluribus, is on Apple TV. It's not on AMC. And so their heyday seems to be well and truly behind them. But they've got an interesting business model, which we'll go over, and there may be some upside left in them yet. So they're basically making money by owning and distributing TV brands and shows. And basically they can't compete with Netflix or Apple TV. So they're trying to take more of a niche approach to culty shows and the audiences around cult shows, I think, is where their focus is. And doesn't seem to be working for them really at the moment, but they might be able to pull a rabbit out of a hat, or they might just get acquired something, or they could just go out of business. We'll see what happens. Their website says, our mission is to be the premier destination for passionate and engaged fan communities around the world with entertainment that stands out, drives popular culture, and fuels our growth. We create and curate celebrated series and films across distinct brands and make them available to audiences everywhere. So that sounds good. Can you execute on that? I mean, that's what you did do.
Mm.
My camera's going blurry again. That's what you did do once upon a time. Whether or not you still do that remains to be seen, but it's a nice vision. So they have their own channels, their own streaming subscriptions, and then they license the right to distribute their shows on other platforms. The old engine is linear TV. Pay TV operators would pay AMC a fee to include channels like AMC, BBC America, IFC, Sundance TV, WeTV in bundles. I was saying to you off air that I don't really understand cable TV because I never had cable in Australia. Cable was late to Australia. We did have it eventually, but it wasn't a big thing like it was in the US. We had a couple of cable channels here, but I never really, I think I wasn't watching TV at that point.
I disagree. I think it's been pretty
videos.
big. Foxtel has a large penetration
Really?
into Australian households. There was a couple of competitors. I think Optus is still around. There was a third one which died. It was a satellite cable TV offering. I still have Foxtel. I still watch it as my main source of sport anyway. But yeah, I think
That's
it's
what
time.
I've always thought of Foxtel as sport,
Yeah.
not. I didn't have to get Foxtel to watch Breaking Bad or to watch Mad Men or something like
I
that.
thought you did.
There was
I
mostly.
thought, HBO was on Foxtel. I think until recently you couldn't get HBO in Australia unless you had a Foxtel account.
Right.
Mm.
Well, I used to, I never watched HBO except on DVD. I guess that's where I would get all my HBO shows, The Wire and Sopranos.
Yeah.
And I don't remember. Anyway, I've never had cable, so I don't understand it. And the cable cutting thing, but that's a big thing that I had to read up on that's affecting AMC. But before we get into that, Oz, they also have Acorn TV, British and Mysteries, Shudder, which is a horror network, ALLBLK, which is black-led content, all black, and an anime lane called High Dive.
And all of those are now bundled up in Amazon or Disney or some of the other streaming services as extra subscription packages.
Extras, yeah. So they license that out to the other streaming services. And I gotta say, I don't know if I've said this to you, but I've been saying this to my boys. I'm really, really annoyed by the way that streaming TV has played out. Like, I have one music streaming subscription with Spotify, and I can listen to every song, every album, more or less. I mean, there's some stuff missing, but 99% of anything I ever want to listen to, going back to Robert Johnson and classical music and jazz and, right through to modern stuff, is on there. I don't need to have 10 different bloody music streaming services to listen to all the albums that I want. The fact that I have to have, there's half the stuff that I want to watch. I hear Tarantino talk about a film and I go to try and watch it. No, it's not available. I go to try and watch some old TV series from the 70s. No, it's not available. Like, the fragmentation of TV and film on streaming pisses me off. Like, I'm so angry at all of these guys for making it so bloody difficult.
Talking about cutting cables, basically the people who cut cables are paying the same as their old cable subscription to subscribe to Netflix and Amazon and Disney and all of them. They're all about, when you add them all up, it's about the same as having a cable TV subscription.
If you subscribe to all of them. Like, I refuse to subscribe to all of them. I'm like, no, I'm just going to pick one. I'll watch what's on that. If there's something not on that, then I can live without it. I just refuse to play that game. It's insane. Anyway,
and they're turning into network TV because we get episodes by the week when they drop and all that kind of stuff. So it's what we used to get for free on free-to-air TV. We had to pay for on cable. And now we have to pay for on streaming.
And you get ads.
Sometimes
now. HBO, they give you ads. Yeah. That annoys me. You pay for it and get ads.
So
anyway,
that's why I'm a little bit more skeptical about the future of AI than you are, because I think there's a commercial overlay which people aren't getting. The imperative to make a buck is going to screw it.
Oh, everyone knows that that's going to happen. We're just hoping that there'll be ways around it. But yeah, you could be very well right. It's what has happened. And, Sam Altman's already talking about them putting ads in it. And, it's already, everyone knows it's going to happen to some degree. Anywho, let's go back to AMCX. So the business began as something called Rainbow Media inside the Dolan family's cable vision empire. The Dolans, you ever heard of the Dolans?
One of those Dolans wouldn't be Mickey, would it?
From the Monkees?
Yeah.
No.
Oh.
It'd be great if it was. No, I don't think so. They're New York cable royalty. So Charles Dolan was the founder of this outfit. He and his wife, I believe, when they were very young, in their 20s, early 20s, were focusing on packaging, marketing, and distribution of sports and industrial films, which they produced in Cleveland and then sold to television stations, which syndicated the material. He had a company called Telenews, which he sold in exchange for a job. And then when he was 26 years old, he moved to New York City and founded Teleguide Inc., a service that provided information to hotels. And then he created a company called Sterling Manhattan Cable, which was the first company to wire buildings to have cable television access in its early years. They forged first of its kind agreements to bring New York professional sports teams, cultural programming, and movies into the homes of New York City cable viewers. So cutting edge of cable. And then he sold Sterling Cable's Manhattan operations to Time Inc. and renamed his Long Island business Cablevision Systems. In the early 1970s, Charles Dolan founded Home Box Office, the first premium programming service in the cable television industry, which he sold to Time Life. His business model was start things and sell them to Time, basically. Sell them, grow them, sell them to Time.
The Bank of Time.
Then he organised Cablevision Systems Corporation on Long Island. He only died a year ago, December 28th, 2024, at the age of 98. So he was pretty much the pioneer of cable TV, this guy. He was the real deal. So back in 1980, when he had this company called Rainbow Media, it was a joint venture between Cablevision, Comcast, Cox Communications, and Daniels and Associates. They said, if you want to be part of our joint venture, your company needs to start with the letter C, but they made an exception if it was the letter D for Daniel and Associates. They had a hybrid service which launched on December 8th, 1980, which broadcast nightly on satellite time, subleased from the National Christian Network, and consisted of feature cultural events from what is now Bravo on Sunday and Monday nights, an adult-oriented B-movie network called Escapade for the rest of the week.
Sorry, that was on the Christian satellite, was it?
Yeah. Like, Christians don't mind turning a blind eye if there's money involved, Tony. Yeah. Let's talk about indulgences during the Crusades. Hey, you want to go and rape and pillage? Not a problem. Just give me 3 gold coins and you get entry to heaven guaranteed. Guaranteed by the Pope. So they had 4 cable companies involved, so they grew quickly. They had lots of subscribers. By July 1981, they expanded their offerings to 7 nights a week. In August of 91, Playboy Enterprises became half owner of Escapade, which introduced a new programming block to the channel in early 1982. And by the end of 1982, it relaunched as the Playboy Channel.
Still on the Christian satellite?
Porn, the Christian satellite. Yeah.
First of all, how did the Christians get their own satellite?
Wow. There's a lot of money in Jesus, Tony. A lot of money in Jesus. By early 1983, it had 400,000 subscribers who paid between $6 and $9 a month, put it in 5th place behind mainly movie cable channels such as HBO and Showtime. Penthouse also had a cable channel in those early days separately, but yeah, it was the big days of Playboy and Penthouse. Because what else are you going to pay for to watch at night? AMC Networks was spun out on as its own listed company in 2011, but has remained a controlled company. The Dolan family keeps voting control via super voting shares, Rupert Murdoch style. And I think that's one of the reasons why the market doesn't really love AMCX, is because of the Dolan family's control over it.
Take it over.
You know, and it's hard to win a vote too if you're trying to get the company to do something. If the family doesn't want something to happen, you can't vote them into wanting to sell it. Governance risk is a real part of the AMCX story, especially when the industry is shrinking, capital allocation choices matter. Other shareholders wanted to do this, that, or the other, but the Dolan family calls the shots at the end of the day.
Which can be good or bad. I mean, love or hate Rupert Murdoch, he's been very successful. So oftentimes I'm sure Mr. Dolan was, not only a pioneer in the cable industry, but knew it inside out and would make the best strategic decisions.
And his kids run the business now, so whether or not they are as smart as he was remains to be seen as successful. But, we love skin in the game, and we don't yet score it on our US buy list. I haven't got around to doing that. But, when you have families that have a lot of personal investment in a business like this, usually they're going to make selfish decisions to increase the value of their shareholding. So we put a lot of stock in that, but we'll see.
Just as an aside, would it be easy for your code to look for Class A, Class B shares in the US as a way of identifying founder-led companies?
No, I don't think so. I mean, not if I want to get it out of Stockopedia. If I start looking at other sources, I might be able to do that and collate it all together. So obviously the crisis for this business has been cord cutting of cable. Every household that cancels cable is one less household paying AMC's rent through the bundle. And so they responded to that with two big moves. First, they doubled down on targeted streaming rather than general streaming. Second, they leaned harder into content licensing. So as you said before, a lot of AMC shows are on bigger platforms to generate cash and to act like marketing for AMC Plus. So you watch season 1 on Netflix, and then if you want to see the rest of the seasons, you have to go sign up to AMC Plus to get the full content stream. So they basically use Netflix as a billboard, basically, to drive audiences to AMC Plus. I've got a lot of background here on cable that I thought would be interesting, but you're like, nah, I'm the only person who doesn't understand how cable works, so I'll skip all of that.
And look, you haven't missed much. There was 200 channels on Rogers in Toronto when we lived there, and not many were worth watching, and there was, I don't know how many there are on the Australian cable version here, 100 maybe. I watched probably 2 or 3.
My mum has free-to-air TV. We don't have free-to-air TV in our home in Brisbane. I'm visiting my mum, by the way, for American listeners, over Christmas. And so I flicked it on the other night, started scrolling through the free-to-air TV channels. It was reality TV, reality TV, reality TV, reality TV, reality TV. I'm like, seriously? That's all it is now? It's just reality shows, wall-to-wall reality shows. And somebody must be watching them. I mean, I have less than zero interest in watching any reality show, but that's pretty much all it was.
Yeah.
It was shocking, really shocking to me. Anyway, I guess they're making a buck off it somehow. But getting back to the 200 channels you said, apparently, so my deep research into what killed cable was most people realized they didn't watch 90% of the channels but were still paying for them, and the bills were going up. So when streaming came along in the 2010s, Netflix started the streaming revolution. People realized they could pay one app, one price, cancel anytime, no bundle, and people started getting rid of their cable subscriptions, which had a big impact on businesses like AMC that were just getting paid money by cable companies, whether or not people watched their TV shows. They were getting guaranteed money coming in every year, which they could then invest in TV shows. But that the cord cutting basically killed their old business model. Lost its affiliate fee that they were getting, lost it immediately and lost it forever. So it took a big chunk out of their revenues and their business model moving forwards. So they've had to pivot, and judging by the numbers, they're struggling. And they didn't lose talent so much as they lost the economic environment that allowed them to subsidize risk. Obviously, when you're making TV shows these days, huge budgets, particularly post like Game of Thrones and shows like that, you've got to compete. You've got to be willing to sink a ton of money into these shows. And it will be interesting to me to see how AI does change that in the next 5 years. Will you be able to make a show that looks like a big budget show for a lot less money if you're using AI to do all of the special effects rather than teams of humans using CGI and spending a year to do it? If you have AI actors instead of Hollywood stars, will they be able to make high quality shows a lot cheaper? There's an interesting show on YouTube that I watched last night. It's a Star Wars show that's all made with AI. There was this episode last night of Luke Skywalker, a young Luke Skywalker, going to meet Darth Bane and talking about how he was going to start a Jedi Academy, and Darth Bane was telling him about all the problems that the Jedi had and why the Sith system of only two, a master and a student, was superior to the Jedis and all this kind of stuff. And it wasn't perfect. The lip synchronization of the dialogue was a little bit flawed, but it looked like a young Mark Hamill, and it was pretty bloody good. And I was like, and it was far more interesting to me and entertaining than anything that Disney or Lucasfilm have put out in the Star Wars universe. So I was like, well, give this another year, 2 years. And I mean, apart from the lawsuits, I think it'll be interesting when fans can make better Star Wars content than Lucasfilm or Disney can for a fraction of the price.
Well,
anyway,
the business models will evolve. I mean, imagine in that sort of world, Disney probably takes the best fan base, correct content, and puts $1 billion behind making it into a big budget movie. Blows it up into a really high production valued series or whatever, does the Game of Thrones treatment to it.
Or just says, we'll license the Star Wars characters to you, go make your own thing. And, if it's a hit, if you make money out of it, you pay us 10% of, gross. I don't know. We'll just license it out.
Sell Star Wars like Lego. Put it together yourself.
License the IP. Yeah. Anyway, so the problem with these guys have is that they just don't have the money coming in to invest in the shows. If you don't have the shows, you don't have the audience. The world that existed when AMC was making these hit shows no longer exists.
To be fair, they kind of created the world too. I mean, we talked about that book on the TV industry, Difficult Men, where it talks about the creators of Mad Men not being able to sell the idea to any of the big players in the industry, and then turning to AMC, who, based on my experience in Toronto, was showing movie of the week type stuff 24 hours a day, very cheap budget movies. And they said, yeah, we'll take a risk and put all this money behind Mad Men. And they pivoted to that. Took off for them.
Yeah. I mean, HBO, I think, started with Sopranos, and Fox was doing X-Files, and you had Twin Peaks going back a little bit further. But yeah, really, Mad Men, Breaking Bad, The Walking Dead, these were massive investments and bets that they made that paid off.
And nothing like AMC fare normally. I mean, I watched AMC as one of the channels you'd flick through in Toronto, and it was wall to wall, Walking Dead, Breaking Bad, and then it would be, Charlie got married and all these, wholesome little low-budget movies that they ran continuously in the daytime and the nighttime after Walking Dead had finished.
Yeah.
Mm.
So now they've sort of stopped being the hot new auteur network and become the franchise recycler.
Mm-hmm.
Lots of Walking Dead universe spin-offs, smart adaptations with built-in audiences. Their big hit show at the moment apparently is An Interview with the Vampire series based on the Anne Rice novels, which I enjoyed when I was in my teens. Read a couple of those. Still, part of me wants to be an immortal vampire like Lestat, just live for 1,000 years. I think that would be cool. The killing and the drinking of the blood thing, not a huge fan of that. But if I have to do it to be immortal, I'm willing to pay that price. As long as Chrissy gets to be immortal with me, that's the main thing.
Or a Tilda Swinton type vampire gets to be sort of grunge rock and roll character and living in the shadows, killing like once in a generation.
Really?
Yeah.
Tilda Swinton was a vampire?
Yeah, it's a great movie with, who else was in it? Gary Oldman, maybe? They played these really cool vampires who, lived in the, yeah, I forget now what the name of it is, but it was a great movie.
He was vampire in Dracula, wasn't he?
He was Dracula.
Coppola's Dracula.
I'm confused, but
yeah.
I'll look it up while you're talking. I'll try and wait.
Okay. So now they're doing targeted streaming and licensing, and look, from what I understand, I don't watch any of their shows really anymore. They do have some shows that could be big hits, but they actually haven't converted yet. So they're still working on these niche things, not the mega franchises. It's more niche properties, franchise recycling. They still have good shows, but not really define the era shows like they had 10, 15, 20 years ago. They report two big segments, domestic and international. Domestic is the heavy lifter. International is smaller, but still meaningful. In FY 2024, they reported $2.421 billion net revenues overall. And in filings, they break their revenues down by type. Subscription, bundle fees, plus streaming subs was the biggest slice, then advertising, then content licensing / other. And they've been sort of widening the targeted portfolio side of things. They bought a company called Sentai, which included anime distributor Sentai Filmworks and the High Dive streaming service. This was in early 2022. So they're trying to drill down into that anime segment. I can kind of see what they're going for with this niche approach. It kind of makes sense because they really can't compete with Netflix and Disney and Apple, and I guess HBO Max fits in there as well. The guys with the really, really deep pockets. Who's Larry Ellison buying? I mean, it's Paramount is Plus, right? They have Paramount Plus.
Mm-hmm.
I think they're trying to buy Disney, no, HBO. HBO, I think they're trying to buy too. Anyway, the last quarterly financials were pretty bad. Q3 revenue declined 6% year on year, but still beat analyst expectations. Their adjusted EPS for Q3 missed analyst estimates. I'm using Q3 numbers because the Q4 numbers won't be out for a little while, obviously. Adjusted operating income for Q3 also beat analyst expectations. They did highlight growth in streaming revenue and strategic partnerships. They expect their full-year free cash flow to come in around $250 million, streaming revenue to become the largest domestic revenue source this year. Streaming revenue increased 14% due to price hikes and strategic partnerships. Affiliate revenue decline, though, fell 13% due to subscriber declines and lower contractual rates. And also there was a drop in their content licensing revenues of 27%. It says due to timing and availability of deliveries. So not a happy picture year on year with their finances. The old cash machine of TV is still throwing off real money, though. The market narrative says cable is dead, but cash flows don't die in a straight line. They're shrinking, but they're still harvesting affiliate fees and ads while they're cutting costs. So operating cash flow, TTM, I've got at 314.5 million, free cash flow at 269.5 million. Even though the EPS looks pretty ugly, the business isn't CapEx heavy, which means they're not pouring billions of dollars into factories or new shows. They're really focusing on cutting costs, content and marketing, and that money is still coming in. I mean, it looks a little bit like a zombie on the income statement, but it's still coughing up quite a lot of cash without a lot of outgoings to, bring in that licensing and advertising revenue.
Reminds me a bit of a back catalogue for a David Bowie or someone like that Wall Street will bundle up and say, we can sell this continuously and therefore it has an NPV value to us. So if you took Walking Dead and Breaking Bad and Better Call Saul and Mad Men, they will have a value, which Wall Street can calculate based on how often they're watched going forward.
Yeah. And, this niche focus that they've got on horror, British mystery, anime, they're talking about super serving a small group rather than pleasing everyone, going very, very niche. Kind of makes sense to me. On their subscriber disclosure, they reported 10.4 million streaming subscribers in Q2 2025. And they've been emphasizing their streaming revenue is growing even while their linear ad revenue is falling. So the company is still alive, but streaming isn't big enough yet to fully replace the old cable revenues, but it is big enough to be a lifeboat. And, they have the option to own the customer relationship directly instead of being a tenant inside of someone else's bundle like they used to be in the cable days. They can potentially monetize it in different ways. Again, it comes down to good execution, but it gives them something to work on. But it's cheap because the market thinks it's a melting ice cube, basically, with debt strapped to its back. It's priced like its entire cash flow is about to collapse. And the reason it's on our buy list is the price to operating cash flow is 1.36 and the price to book is 0.405. So it's real distress vibe multiple pricing there, which, I can understand it from a big investor perspective. And by the way, one of the things is they're not really big enough. I think their market cap's like 500 million. So they're not really big enough for a lot of really big funds to get involved in and play with, but big enough for most individual investors. The market, though, is looking at the cord cutting that's happening, weaker advertising, streaming that never reaches attractive margins because it's too small, and the governance issues that I mentioned before with the Dolan family controlling the structure that can block a sale or prioritize control over value. So there's a lot of things that I think are keeping the bigger investors out of the game with this, but none of those really bother me. The business is generating cash and it's cheap. For the time being, I'm happy to play with. I don't care about the Dolan family's control. Again, I trust that their instincts will be to make as much money as they can for as long as they can out of it. So their interests may align with our interests. In terms of the catalysts, nothing really magical, more mechanical. The free cash flow delivery continuing while they clean up their balance sheet. They also have Netflix licensing coming in that can generate cash and can act as a billboard for AMC Plus, as I said before. There's also the potential that they could get bundled up and sold off to somebody else, right? I think that's probably in their future. Maybe Larry Ellison and his son will buy it and turn it into, another marketing arm for MAGA. Who knows? Part of the Larry Ellison's MAGA Israel network.
The Walking Dead network. I was just putting the two together.
Wow. Yeah. That's going to be the title of the episode. You just nailed it. The Walking Dead investment. They are the Walking Dead. Yeah. It seems that way.
Well, I think you're right. I think
share prices.
Sorry to interrupt. I think you're right. I think there's
You're right.
out of all the things you've said, I think the thing which strikes me is that, I don't know if it's on their books at the right value because I haven't looked at their books, but there's those 4 franchises have a value, and I suspect they're being undervalued on their books. And I expect that they'll be attractive to someone to come along and say, hey, I can pick up these 4 franchises for a song at 1 times cash flow, and I can bolt it into Amazon, Disney, MGM, whoever. And it'll repay itself 10 times over the next decades as people watch these things endlessly.
Those shows are, in my opinion, totally rewatchable.
Mm-hmm.
I mean, I've rewatched Mad Men 3 or 4 times, Breaking Bad a couple of times. Better Call Saul I haven't rewatched yet, but I will. But they're great. Like, for me, those shows are like Sopranos or The Wire, or Deadwood or Succession, which I'm rewatching now. If I'm doing something in the background, if I'm working or I'm making dinner or cleaning the kitchen, I'll just put one of those shows on in the background because I know them so well. I know the characters. I know the storylines. It's comfort food, television for me, right? It's like, yeah, I mean, I can pick a random episode, and to me, it's like putting on a random Alice Cooper album or a Beatles album. It's like, I know it so well. It's just background music that I can laugh at the characters and the dialogue. Oh, remember this episode? This is a great episode, whatever it is. So share price is around about $9.80. Market cap's $426 million. So, as I said before, sub 500 million market cap means fewer institutions can really own it comfortably, which might increase the mispricing potential. What it means for the business is the market is basically saying, we don't trust your future. But for us as smaller investors, if the cash flow proves durable, it could be re-rated by somebody at some point for some reason. We don't really know, but that's not my job to predict their future.
But I think it's pretty clear. I mean, market cap of $500 million. Would you pay $500 million for those 4 franchises if you were a streamer? You'd pay 2 or 3 times it.
Yeah.
And
probably.
And they're probably taking the kids out to lunch all the time saying, hey, it's good to own the AMC network as a company, but we'll pay you 3 times for those 4 franchises and you can exit gracefully. Yeah. Why wouldn't you take $1.5 billion or $2 billion or more for what you've got?
Yeah, I mean, look, everybody of a certain age has probably seen those shows, except you. But there are generations that haven't.
Well,
I mean, my kids
correct
that are 25 have seen Breaking Bad and Better Call Saul. They've never watched Mad Men, and they've seen Walking Dead. So they love 3 of the 4 series, and they'll watch Mad Men one day when they're old enough. Fox will watch them all. He's only 11, but he'll watch them all. I don't know how many Alex has seen. She's probably seen some of them, if not all of them, I imagine. Yeah. She watched those shows?
I don't think so, no. Sean does. But not just that, Cam, but if you're an Apple or an Amazon, you bought 4 strong IPs. So you can keep showing those ones. They're your cash cow, but you keep making them too, just like Disney did with Star Wars. And they might be inferior.
I don't think you can.
But,
I don't think you can make more Breaking Bad episodes.
Why not?
Or more Mad Men episodes.
Son of Walter White.
Really?
Yeah.
He had a son.
There you go.
I'd watch that show.
There you go.
Yeah. Or the Jesse Pinkman show. I'd watch the Jesse Pinkman.
So AMC can't afford to do that, but there's probably executives in AMC who already have the scripts for the next 10 years for the spin-offs, and they get sold.
And again, AI, man. Come along at AI in a few years and say to Vince Gilligan, hey, we want to do a spin-off of Breaking Bad, and it's going to be all AI driven, and it's going to cost, $1 million, and we can do a series that'll bring in 10 million in revenue. Do you want to cut? Anyway, back to the numbers. As you said before, their forecast EPS is not great. It's negative. So is their basic EPS, including extraordinaries, is negative. So they're not predicting a great earnings season coming up. Basically, that shouldn't be surprising. It's not going to be a great earnings, but that doesn't mean it's not generating cash flow. It just means that it's going to be paying down debt. It's going to be losing money in different ways in the accounting books.
That's one of the things I didn't like about this company, Cam, was the accounting. So you've outlined all the numbers and they generally are in decline until you get to a couple of pages in the accounting statements which say, we want to go off piste here and use non-GAAP metrics because I think they apply to our business more.
Yep.
And then suddenly they make a profit, a bigger profit. I think they make a profit now anyway. It's just in decline. And they add back things like amortization, and they add back all the non-cash items, and they add back payment expenses and all the things that Charlie and Warren have cried foul on for years. And that was a big black mark for me when they start relying on those kinds of things to make them look good. Let's stick to GAAP. And I mean, they don't look bad under GAAP. They're in decline, but it's not like they're in decline by 50% a year. They're in decline by single digits, which means they've got plenty of cash to fix that, and they'll eventually find a base and probably go upwards again. And their share price has started doing that because, as you say, they beat the analyst numbers this quarter. But when I got to the bottom of the accounting statements and they said, hey, don't listen to the GAAP numbers, listen to these, I'm like, no thanks.
Well, we don't score companies based on whether or not they stick to GAAP accounting.
Yeah.
Maybe we should.
Yeah.
We might have to add that into our US checklist.
Well, we use the GAAP accounting to score them, so who cares? But I thought that was a bit of a stain on their management approach to business.
Right. Well, some other numbers that do look good, though. The Stockopedia quality rank is 80, the stock rank is 97, and the Petrovsky F score is a 6. So these are all pretty solid health scores that we pay attention to. So look, it looks bad on some metrics, but according to those, it's a good quality company that is got a good financial trend, and it can be bought quite cheaply, as I said before, with that price to operating cash flow and the price to book metrics.
And has quality assets.
So,
and I think it was also doing a buyback, which will help its share price. So there's like a lot of these things, there's some things to dislike and there's a lot to like.
Yeah. So anyway, it was at the top of the buy list. I added it to our light portfolio because of that this week, and we'll see how it goes, Tony. It had a QAV score, by the way, of 0.57 when I added up all the numbers, which is pretty high for us. So that is a long episode for us, and that was AMCX.
Very good. That's good.
Another television.
Good analysis.
2 stocks, 2 television businesses.
Which is not surprising for a value investing podcast. I mean, it's a cigar butt industry, isn't it? This could be the Berkshire Hathaway of the 21st century. Who
would have thought?
No, I know.
Who would have thought the television businesses would have been the cigar butt stocks?
Yeah, and, looking back...
Well, it's been through a lot.
20, 30 years, they were the kings of the universe, the network executives, weren't they?
Yeah, and I mean, you go back to AMC in the Mad Men, Breaking Bad, Better Call Saul days. If you said you're going to be a bargain basement stock in 5 years, 10 years, who would have thought? Anyway, there you go. That's the show for this week. And my camera's blurry again. It does not like this, but there you go. Maybe it's had too much to drink, like me, over this week. Thank you, Tony.
Thanks, Cam. That was good.
Happy New Year.
You too.
And I'll talk to you in the new year. What are you doing for New Year's? I didn't ask you before.
Absolutely nothing. We no longer live in Sydney, so we can't watch the fireworks from our balcony, which is a bit of a shame, but we'll go back to what Jenny and I normally do, which is to be in bed by about sunset, which is about 9:30 here.
Are they still doing fireworks, or have Bondi shut it all down? I thought they have lots of things are being shut down because of security concerns this year.
Okay. Well, last I heard, they were
That's what I heard.
Yeah, right.
Right. Well,
see you next year.
You have an old person's New Year's. I'm going to go to Bundaberg fireworks probably.
Oh, nice.
Which will be lame.
That's
But small country town fireworks.
Oh.
Just a couple of guys with lighters holding them up in the sky, just going whoop.
That'll be nice.
Set a couple of cows on fire. Maybe a sugarcane field. Set a sugarcane field on fire.
That is spectacular.
All right. Thank you, TK. Have a good one.
Bye.